What is happening here is that the shorts are buying back their positions, but they're not rolling over. They're not holding to delivery because they don't want to deliver and they don't want to hold the short contracts into February. And therefore, fewer contracts are being sold forward in February or sold short in February, which means the price is going up because not as many people or not as many parties are willing to sell the contracts at this price.
The big concern in the next couple of weeks, frankly, will be the Federal Reserve. And you mentioned 85% basically probability. That's what the markets are saying, 85% probability of a rate cut. And gold has priced that. Gold has priced that in. 2 weeks ago, it was more like 50-50. In fact, it was even a little less than 50% for a rate cut. But at this point, with an 85% probability of a rate cut, and with gold having already discounted that, the risk, of course, is that the Fed either doesn't cut or cuts with an extremely hawkish message, and that could see gold come down.
The precious metals market is entering a highly stressed phase as silver pushes deeper into record territory and future shorts rapidly unwind. Contract supply is tightening, physical premiums are shifting, and the market structure is revealing conditions that typically precede major upside continuation. Rafi Farber, a monetary reset analyst, and Adrianday, a veteran resource sector strategist, outline how the current setup reflects a real-time short squeeze rather than a speculative surge. Since mid-November, more than 60,000 gold contracts have closed, while the price has risen from $4,000 to above $4,250. New York silver stocks have fallen by over 80 million ounces, London discounts have returned, and Shanghai inventories sit at 10-year lows. Junk silver premiums have collapsed to nearly zero, indicating aggressive physical absorption at spot, while open interest in gold has reached levels historically associated with final downside exhaustion. Miners are also flashing long-term bullish signals as the gold to HUI ratio tests a structural trendline dating back to 2016. Both analysts emphasize that the entire futures system becomes unstable as the dollar weakens, with exchanges inevitably transitioning to physical pricing once monetary confidence breaks down. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
There is a short squeeze going on. I will show you mathematically how it's happening and who are the victims of this. And also we're going to talk about palladium, which looks like it's having another record delivery month. So on the latest silver move, up to $57, we have here the junk silver premiums have hit zero. I think the feed for this data is from Monex or Monex, or however it's pronounced. I think that's where they get it from. You can see here that the premium on junk silver coins, which I think is the most appropriate form of silver because it's the most recognizable in the smallest denominations at the smallest premium. That's 0.04%, essentially zero. You can get junk silver, physical silver coins for the same as spot right now. So this is a pretty good deal. Anyway, we're going to go to the next slide here. London spot silver premium returns. Yes, silver went up to $57 yesterday or on Friday, on Black Friday, on low liquidity and low volume. So we have here, this is the silver futures spot silver spread. When it's negative, that means there is a premium for New York silver over London spot. Some people call this backwardation. I don't call it backwardation. I just call it a premium on New York. Whatever you call it, it's happening again. You can see this was the record premium in New York in October when silver hit about 54, 55. That was, everyone was freaking out about that. And we got rid of the premium. This is the normal state of the market. This is a sort of a kind of a backwardation, but not really a backwardation. I have other videos on why it's not a backwardation. I'm not going to discuss that right now. But anyway, the New York premium or the London discount on London spot silver has now reappeared. It's at 0.3%. It was down to 1% as of 2 days ago, or I think that was Wednesday, right, the day before Thanksgiving. So the conditions that led to silver flooding into London from New York have reasserted themselves. Let's go to the next slide here. You can see here why this is probably the bottom in gold, and by extension silver is already in. It's not going to help you much with silver because we're at new all-time highs, but we're not yet in gold. We're at 4250. I think the all-time high was close to 4500. But we see here the interaction between the price and open interest here. Every time we have hit this level of open interest or near it, we have hit a bottom in gold. You can see here, this is when we were back down to about 400,000 contracts in March of 2024. This was a bottom in silver prices. It took price a few weeks to move from here, but it didn't go any lower than this. Same thing here. We hit about 400,000 in June, July 2024. Again, we see a local low in gold here, and from here it went up. We see it again over here. This one took longer, but price did not move substantially lower than this area. It was between about 3,500 and 3,200, 3,300. It was bouncing around very tightly, but not because of, but in correlation with open interest, the amount of contracts open on the New York futures market. It was around this number, and price did not go substantially below here. So now we are at 420,000, I think. This is one day old. This says 432,199, but we are at about 420,000 now because of deliveries that have been made in the last few days, and that closes open interest, that closes contracts. So you can see here is a bottom. I don't think we're going to go below 4,000, maybe never, maybe only once in the final crunch. I don't know. But even if we do, it's not going to be for a very long period, so I wouldn't even try to time it at all. This is very likely a bottom here in gold, and we can see that from the open interest, and it's going to be the same pattern here. I don't know that for sure. I could be wrong, but I'm just going after the last 3 instances of when this happened. When we hit this level in open interest, we're hitting it again. I think we are at or close to a bottom in gold that has already been hit. Now we're going to go to the next chart here, and this is where we see the short squeeze. It's not an incredible or spectacular short squeeze, but mechanically that is what's happening. How do we know this? Because since the middle of November, right, we see here that open interest, I drew the line here, was about 480,000 contracts. Now we are down to 420. That's 60,000 contracts down, closed out. And in that time period, we went up from $4,000 to $4,250. So contracts are closing out and price is going up. That means that shorts are closing at higher prices. That is the definition of a squeeze, and that's what it is. That's what's going on right now. Now, we're going to go to the silver drain from New York. It continues. It ebbed here for a while, for about 2 or 3 weeks, from the end of October to the middle of November, and then it has accelerated again. Now we are at 458 over here, 458 million. From the beginning, from the huge London spot premium, we were at 532 million. Now we're at 458. That's about 80 million something contracts, not contracts, 80 million ounces of silver have been drained from New York. Most of it probably going to London, though probably not all of it. Some of it might be going to Shanghai. We'll see when we have those numbers. The Shanghai silver stocks, by the way, are at 10-year lows at 520 tons. So we see here 520 tons. What is going to cause silver to flood back in? There's going to have to be a Chinese or a Shanghai premium on silver. We'll see if they can get that, or maybe there's going to be problems in Shanghai. Who knows? The exchanges are under stress. Maybe the cooling incident had something to do with it. This has to do with gold stocks. This is the gold to Huey ratio. The higher this is, the cheaper gold stocks are in terms of gold. The lower it is, the better gold stocks are performing in terms of gold ounces. So we see here we have re-hit a major trend line that has been in place since 2016. This is the all-time bear market low in gold stocks in the end of 2015. This is the 2020 crash, and here is the bottom trend line. It was hit in 2016. It was hit again in 2020 during that gold bull run, gold stock bull run, and here it is hit again just a few weeks ago, and we're touching it again over here. So it looks like this trend line wants to be broken. If it is going to be broken, we have a long way to go before we get to 2011 lows here at about 3. And it goes even below that, meaning that gold stocks are even better relative to gold. Once we break this trend line, we're in space here. And it could get pretty exciting for the gold miners and the gold streamers, and of course the silver stocks as well, which had a fantastic day on Friday. And so to end this off, I want to begin where I started, and that is, don't pay too much attention to the theories going on about what is happening in the CME, because all you have to know is that the CME and all the other gold and silver exchanges and the other futures exchanges and everything, it's all going to collapse once the dollar collapses, because everything is dollar denominated on these exchanges, and once the dollar collapses, then no more trades in dollars can be made. You have to trade in gold and silver instead. That's going to take a little bit while to recalibrate. And in the meantime, the exchanges are going to go down. That's going to happen eventually. You don't have to concern yourself with the proximate cause of why exactly it's going to happen, if it's going to look like a coolant failure or whatever. All you have to know is that once the end game reaches 88 miles per hour,
gold is entering a sensitive period as markets price in an extremely high probability of a Federal Reserve rate cut. With the likelihood now near 85%, the metal has already absorbed much of this expectation, leaving near-term movements more dependent on how the Fed communicates rather than the cut itself. How gold has increasingly decoupled from the dollar, driven by central bank accumulation rather than U.S. investor flows. Domestic buyers remain tied mainly to economic conditions, weakening growth, rising inflation, falling real yields, and a softer currency, while international demand is motivated by long-term wealth protection. The dollar's recent rebound appears modest relative to its most significant first-half decline since the mid-1970s, and with interest rate differentials narrowing, structural pressure still favors a lower trend over the next year. Meanwhile, expectations for a softer economy, persistent inflation, and policy shifts continue to strengthen the long-term case for gold, as fourth-quarter corporate results are likely to improve. Let's get back to the interview.
The big concern in the next couple of weeks, frankly, will be the Federal Reserve. And you mentioned 85% basically probability. That's what the markets are saying, 85% probability of a rate cut. And gold has priced that, right? Gold has priced that in. 2 weeks ago, it was more like 50-50. In fact, it was even a little less than 50% for a rate cut. But at this point, with an 85% probability of a rate cut, and with gold having already discounted that, the risk, of course, is that the Fed either doesn't cut or cuts with an extremely hawkish message, and that could see gold come down. So, as you know, in this business, we're not really in the business of making predictions as to what's going to happen. It's looking at what we think is going to happen in the context of risk and reward, and in the context of what's already discounted in the market. I think gold has to a large extent diverged from the dollar, because again, it's been central banks that have been buying, and they are not overly concerned with the level of the dollar. Now, if the dollar were to collapse, it would add to the urgency of central banks to diversify out of the dollar, but I don't think it's dependent upon a weaker dollar. U.S. generalist investment is to a large extent dependent on the dollar, because U.S. investors, or North Americans generally, but North Americans don't buy gold in general terms, don't buy gold for the same reason that people in Asia or people in the Middle East or people in Europe buy. We don't have, in North America, they don't have that sort of history of where gold actually saved you. The Chinese in Hong Kong have that history where gold, when they brought gold over after Mao took over, it saved them. Vietnamese have a history of gold. Germany, Italy, these countries, is still in the DNA that gold is a safe haven asset. We don't really have that in North America. So in North America, people tend to buy much more on simply the economic environment. So that's a weakening economy, lower interest rates, high and rising inflation, and a lower dollar. And the truth is that up until very recently, I think one could argue that all of those four factors were exactly the opposite of what they need to be to get people interested in gold. Now, with regard to the dollar, so I think the dollar is important for U.S. investors. I don't think it's very important for the main people who have been buying, and that includes Tether, the Chinese, the central banks. I don't think the dollar is that critical for them. We know that the dollar had the largest first half decline since 1974. That's pretty astonishing. And so after you get something like that, and of course the first half of the year is an arbitrary measurement, but nonetheless, it was the sharpest first half decline since 1974. After something like that, you would expect a recovery rally. And I would argue that the recovery rally we've seen, from 97 or something, 96.5 to 99.5, The recovery rally that we've seen is very, very mediocre. And so I wouldn't be at all surprised if the dollar maybe goes up a little bit more, 100, 102 on the Dixie, but a year from now it's likely to be lower. And that's particularly since if the Federal Reserve is cutting rates, meaning the arbitrage between US rates and foreign rates, closes even more. And you've got an administration that doesn't seem particularly interested in having a strong dollar. So I think the odds are that the dollar weakens over the next, year, 18 months, albeit after a bit more of a recovery in the near term. But this recovery is very, very mediocre. Who missed that rally on the way up and now are wanting to take advantage of any decline. So that could be anyone. That could be central banks tend to be price inelastic, but it could be, anyone that just thought they missed it. And yeah, on a fundamental basis, I think it is primarily the Fed. And if you look at when the futures on the Fed cutting in December was under 50%, that's when gold was under 4,000. And now as the odds of the Fed cutting have increased, so gold has increased. I think that's one of the main things. But there's also, from the US investor or North American point of view, again, there's a growing sense that the economy is not as strong as the narrative 3 and 6 months ago suggested. That's certainly growing. And a growing weakness in the jobs market in particular. You've got inflation that is staying stubbornly above the Fed's arbitrary 2% rate. Let's not forget that other than the COVID spike, inflation measured by the CPI, that's not really inflation, but measured by the CPI is still above where it has been for the 5 years before COVID. It's only a COVID spike that makes us think that the inflation rate is low. So you've got stubborn inflation, and yet you've got a Federal Reserve that is likely, whatever they do in December, over the next 6 months, they're likely to cut rates more as President Trump puts his people, onto the board. And so the narrative of a strong economy, a strong dollar, high interest rates and low inflation, that narrative, however true it was or wasn't, but that narrative is certainly shifting. And that's making US people begin to look much more at gold. The fourth quarter should be very, very strong, not only because of the gold price, but the costs haven't moved up, but also an awful lot of the big companies have said all year that they're back half weighted and the final quarter will be their best quarter. They've said that all year. And so I think the fourth quarter should be very, very strong when we get those results.
Gold is navigating a pivotal moment as rate cut expectations rise sharply and the market adjusts to shifting monetary signals. With the probability of a December cut climbing toward the high 80% range, the metal has already absorbed much of the policy outlook, leaving traders focused on how the Fed communicates its next move. A hawkish tone could temporarily pressure prices, but the broader trend still leans toward structural strength supported by global demand. In the broader macro landscape, the dollar's recent bounce appears shallow compared to its steep first-half decline, and weakening economic momentum is beginning to reshape investor behavior. Persistent inflation, softening labor data, and narrowing rate differentials continue to erode the narrative of a strong domestic environment, encouraging a gradual shift toward tangible assets. As inflation remains above target and policy direction becomes more accommodative, gold's long-term positioning improves, particularly ahead of a stronger fourth-quarter earnings season across the sector. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.